Well, I want to welcome you all and thank you for joining us this morning. This is the Legacy Wealth Partners Coffee Chat. Welcome to our latest event entitled Big Ideas for 2021. We have a really exciting discussion for you planned out today. And I said discussion, and that's really designed, what this is designed to be, not a presentation, but more of a conversation. And I think you're going to find this hopefully very interesting and engaging. Before we get into the formal presentation, I just have a few disclosures that I want to give you. So we're going to be sharing with you our thoughts as Legacy Wealth Partners. This is our perspective, okay? So what I'm sharing with you are our particular views about the financial markets, the economy, and investing. Everything we're going to talk about today related to investing are things that we are currently investing in our client portfolios. But it's important you understand what we are talking about is not designed to be a specific personal investment recommendation for you. And for that, we need to have a one-on-one discussion to talk about what's appropriate for you in terms of your goals, your risk tolerance, your objectives, and your time horizons. Also, what I want to do is to give a quick introduction to my co-host, Devan O'Dowd, who I'm now going to bring on the screen. Let's see, Devan is a regional director of GlobalX ETFs, which is a large sponsor of exchange-traded product funds specializing in thematic investing. And I met Devan a few years ago. In fact, I think that Devan and I have probably had 10 conversations in the last couple of years, but I think only one or two of those was in person. A lot of those have actually been virtually. And I talk to a lot of people in the financial world, really on a daily basis. I have conversations with portfolio managers and analysts and people working for investment companies. And I have a lot of interesting conversations, but I have to say, but Devan is one of the individuals that I met in the last few years that is probably more interesting, definitely more interesting than most of the people that I have talked to in this business. I find that our conversations actually move very quickly and we're always running out of time. There's always more that we'd like to talk about that we don't have enough time for. So Devan, I want to welcome you and thank you for joining me this morning. I'm going to unmute you so you can contribute and say hi here as well.
Thanks for the warm welcome, Brad. It's a pleasure to be here. Everyone, as Brad mentioned, I think we've only had 2 conversations in person. We did have cups of coffee and all of the rest of them have been digital or virtual to some extent. But I'd like to say Happy New Year to everyone. I can't say 2021 feels too different than 2020 yet, but I'm hopeful that the rest of the year will bring a little bit of a greener pastures to us. And I'm excited to this conversation today. I'm very passionate about disruptive technologies and innovation. I've got some great comments today and look forward to hanging out with you guys and having a cup of coffee this morning.
Sounds good. Thanks, Devan. So we're going to go ahead and kick it off. I'm going to just jump right into some of the content that I want to share with you guys. And again, what I'm going to talk about really here in the next few minutes is designed to just give you a quick introduction to some of the key themes and factors that we think will be very impactful for the economy, the financial markets, and from an investment standpoint in our client portfolios over the next coming 12 months. So let me just jump right into it here. Big ideas for 2021. And the first thing is that we expect the economic recovery is going to continue. That's the good news. In fact, when we talk about economic growth, the history of economic growth in the United States has been an average of about 2.5% per year GDP growth. But what the consensus of analysts is expecting for this year is GDP growth to be in excess of 4%. In fact, actually, Goldman Sachs is calling for GDP growth of around 6.2%. They're one of the high outliers in that forecast. The other thing is that we expect that the vaccines are going to usher in a lot of the economic recovery and come to our rescue. As you guys all know, the vaccine distributions are already beginning. And we just got the news this morning that Los Angeles is the site of one of the largest vaccine dissemination sites in the country and even in the world, with Dodger Stadium actually opening today for vaccine distribution. Also, Disneyland is going to be distributing vaccines in mass quantities. But the expectation is that vaccines are going to enable the world economy, not only the US, but really the rest of the world, to come back online and get back to more of a normal economic environment in the very near future. And we're all looking forward to that. The other thing is that we expect from the Biden administration is a lot more stimulus to be coming. In fact, coming to your mailbox or a mailbox near you. Yesterday, he just announced his plans to unveil a $1.9 trillion economic stimulus that would include an additional $1,400 potential check to be mailed out to individuals to supplement the $600 that is already being rolled out, that was approved by Congress a couple of weeks ago, bringing the total to $2,000 per individual, and also extended unemployment benefits all the way through September, and including an additional $400 unemployment benefit on top of the standard unemployment benefits. What we also expect is that interest rates are going to stay low for a lot longer period of time. And from my perspective, this is probably the most impactful issue of all for us to think about and to focus on when it comes to investing. Because right now, the federal funds rate is sitting essentially at zero. This is the lowest level it's been at in history. It's been at this level for the better part of the last year. And Chairman Powell of the Federal Reserve is telling us that they expect not to raise interest rates until the end of 2022. And what we know today is while the economy is recovering, unfortunately, there's a lot of people that are still unemployed. In fact, what I read yesterday is that the bottom rung of the income segment of our economy's population has an unemployment rate in excess of 20%. So there's a lot of pain that's still being felt across the country. We need economic liquidity in order to stimulate purchasing demand and borrowing to move the economy in the right direction. So there's a few things that it's important to understand about the impact of low interest rates. The first thing is, for savers, it's a real negative dynamic, because what are you earning today in savings accounts? Zero, essentially. So the prospect for returns on cash investments is very bleak. By the same token, bonds are generating the lowest yields in history. And in fact, in December, the real yield on US Treasuries, which would mean the yield less inflation, is now actually negative for the first time in history. So the outlook for bonds is very bleak. Historically, bonds have done very, very well going back over the last 40 years. In fact, in 1982, the Treasury bond yield rate peaked at over 15%. Today, the 10-year Treasury bond yield is around 1%. As interest rates fall, bond prices rise. What we've seen is for the last 40 years, interest rates were steadily falling and falling until we got to the point where they were near zero. And that boosted the prices of bonds, but we can't expect that to benefit us like it has historically at this point going forward. And the best we can expect to earn on bonds for the most part is just that very paltry yield. As a result of that, that makes stocks and a couple other investment categories really superior from an attractiveness standpoint to investors. We're going to come back and talk about that a little bit later. The other thing, of course, too, is low interest rates is fueling a boom in the real estate market, both in terms of refinancing, which is allowing a lot of families to be able to save money on their monthly mortgage payments, which they can then take and use either to save that extra monthly savings that they're not having to pay towards their mortgage, or to spend it, or to invest it. And also, low interest rates are fueling the prices of purchases of real estate to go higher and higher. So what we see here is a boost of low interest rates fueling stock market prices higher and real estate prices higher, also creating some concerns about possible inflation. So the big ideas that we have in terms of investment themes, we're going to run through today, and I'm just going to show you real quickly what they are, and then we're going to dive into these in my discussion with Devan. But as part of the Biden administration, what we expect is, in addition to the stimulus towards consumers and businesses, a lot of money to be spent on infrastructure. In fact, as a candidate, President-elect Biden laid out plans to invest more than $1 trillion in a massive infrastructure spending program specifically targeting climate change in the form of alternative energy. So we expect that there are going to be some things done in that regard. And what we're already seeing is that stocks related to companies that are in the alternative energy space are absolutely flying as a result of the expectation that Biden is going to be rolling this out. along with all of the massive monetary stimulus, meaning low interest rates, a lot of liquidity in the economy thanks to the Federal Reserve, we're starting to see concerns about inflation. Why? Well, there's a lot of money being printed, as people would say, a lot of dollars being put into the system in circulation. And what happens is the more dollars we have, the more available currency there is to be spent on goods and services. And that could potentially lead to inflation. It's expected this year that we're going to start to see inflationary pressures building a bit. And that has some important implications for investments that are deemed to be considered inflationary hedges, which we're going to talk about a bit as well. Also, we're expecting to see, and we're already beginning to see, a rotation in the stock market in terms of the areas that are outperforming and leading the market higher. What we saw last year is absolute outperformance of technology, especially the large technology stocks, mega caps like Microsoft, Amazon, Netflix, Google, and so forth. What we're now seeing is beginnings of rotation away from these large growth stocks towards other areas of the markets that have been really underperforming for a long time. One of those sectors would be small company stocks. Small cap stocks are actually now breaking out to new all-time highs for the first time after underperforming large stocks for many years. We're also seeing a new breakout in emerging market stocks, where that segment of the market, emerging market company equities, are actually now just hitting a new all-time high, eclipsing its level last reached about a decade ago. So we're now seeing this be an area of excitement and interest for investors. And the other one would be a rotation from growth stocks towards value. What we're seeing is that there is a surge in the prices of companies related to the energy industry, which kind of goes along with inflation. Oil prices spent the better part of last year below $40 a barrel. They're now hovering around 53 today. But Goldman Sachs expects oil prices to be $60 a barrel by the end of this year. In fact, at one point during the bottom of the crisis, oil prices actually approached zero. Early last year during the market crisis around March. So oil prices have recovered substantially, and yet the stocks of energy-related businesses still have a long way to go. We're also seeing a recovery play out in the stocks of financial-related companies, brokerage firms, banks, insurance companies. All of those sectors of the financial sector market have really been lagging a lot of the growth sectors. So we're starting to see money flow into those areas. And also, in a portfolio that we manage called Select Equity, which is an individual stock portfolio, we have over the last few months been pivoting towards the few things that I just mentioned here in terms of these themes. And another thing that we expect that's kind of interesting is that there could be a big push towards the legalization of cannabis for recreational use. What we saw in the election was that 4 new states voted to approve cannabis to be legalized. But what we now expect, because of a blue wave, the Democrats controlling not only the White House, but also Congress, that there's going to be a big push towards the federal legalization of cannabis, which is still legal only on a statewide basis in limited states. And as a result of that, pot stocks are absolutely smoking right now. So they've been taken off because it's expected that these things that I just mentioned, this push towards legalization, will be benefiting those companies substantially. And what's important to understand from an investment standpoint is it's always better to be an early adopter than late to the party. By the time that something actually happens that investors have been expecting to happen, it's really too late to benefit for the most part. The last thing that I'll mention real quickly here before I bring Devan on to the discussion is Bitcoin. There's been a lot of talk about Bitcoin over the last few months, and Bitcoin last year went through a massive correction, dropping all the way down to $4,000 US dollars per coin. And that was after reaching a previous all-time high of just over 20,000 at the beginning of 2018. Well, Bitcoin has fully recovered. And it ended the year over 20,000, but it is now sitting just below $40,000 per coin. In fact, actually, it went over 41,000 about a week ago, pulled back, dropped all the way back down to 30,000, and is now sitting around 36,000 as of this morning. Why is this happening? This is really interesting, and we can in fact have a whole entire discussion about Bitcoin. But I identified here that Bitcoin is getting street cred. And what I mean by that is we're now seeing this is moving from a very speculative asset that was invested in by a lot of young hipsters and millennials that thought that this was a cool thing, to now major financial institutions saying, no, this is a real thing, and investors need to take notice and be aware of the potential of this as an emerging asset class and also currency. In fact, JP Morgan recently said in a paper that they expect that gold share prices are going to lose out as Bitcoin becomes increasing in popularity for investors, and money is going to be shifting from gold towards Bitcoin. We also saw back in October was the digital payments company Square announced they were investing $50 million in Bitcoin. That was followed by PayPal, which announced that they were going to allow their 350 plus million PayPal account users to start having the ability to purchase Bitcoin, taking their cash in the PayPal platform, convert that to Bitcoin and other cryptocurrencies, which was a major move, saying that PayPal thinks that this is something that really deserves widespread adoption. Also, PayPal owns the popular cash application Venmo, and by the end of this quarter, Venmo users will be allowed to pay each other using Bitcoin as an actual currency. What we also saw recently was insurance company MassMutual announced that they were taking $100 million of their treasury reserves, that would be the cash of the corporation, moving $100 million into Bitcoin. And another company named MicroStrategy, which is a business consulting firm essentially, they announced that they were going to invest $400 million in Bitcoin. They actually did a convertible bond offering, raised $600 million, invested that into Bitcoin, and they have now positioned over $1 billion of their treasury reserves into Bitcoin. By the way, that $1 billion investment is now worth over $2 billion today. So what we're seeing is that this is being moving from something that was seen as very speculative for the last several years to something that is being adopted on more of an institutional level as a meaningful asset. We're going to talk about that a little bit more today. But with that, Devan, I'm going to go ahead and turn it over to you and let you take control of the screen and dive into some of the themes that we're going to talk about here in more detail today, specifically as it relates to thematic investing. And as a quick introduction for you, can you start off by telling everybody a little bit about what thematic investing is? Because a lot of people may not be understanding in detail about what that really is about.
Yeah, absolutely. And again, I'm very excited to be here. These are topics I'm very passionate about. I'm going to show everyone a couple of things later, but this is one of my favorite weeks of the year. This week is the Consumer Electronics Show. That's in Las Vegas right now. And that is when you see all the new technology debuted, from 5G towers. GM actually just debuted a flying car, to robots that will pour your coffee. I was an attendee the past couple of years. I write research on that, and it's all digital this year. So I'll show you guys some of this technology has really come to life, and the Jetsons are finally somewhat, to some extent, starting to arrive. To Brad's point, and he made very, very, very strong points there, thematic investing is something, and I work with advisors and institutional investors all over the country. And what winds up happening is a lot of folks wind up buying Facebook or Alphabet or Amazon or Google after it's the biggest company in the market. And what Brad is so good at and why we've connected so well is we've been able to work together, and he's picking up these themes in the early innings. And that's giving a lot of return to portfolios. And these things are fun to allocate to. So I'm going to talk a little bit about how disruptive tech is enabling the reopening economy, but I'll start off by really just kind of giving you an example of what thematic investing really is. And if everyone can show my screen here, I'll just kind of define it real quickly. When you typically manage a portfolio, oftentimes what you hear from portfolio managers is that history is going to repeat itself. We know that the market corrected back then because of X, Y, and Z. And as a result, we're going to use that data to make the next decision to try to anticipate what might happen moving forward. History generally repeats itself. That's a great way to think about investing. We're a little bit different. Thematic investing is we're trying to identify these macro level disruptive trends, such as robotics are playing a role in Amazon warehouses. We have electric batteries in our cars. I'm living here in California. I'm from Chicago, but there's electric cars all over the country now. We are now using connected devices. I have a wireless headset in right now, and these macro level trends start to materialize over time. So when we think about thematic investing, simply put, we are trying to understand what these macro level trends are and what stocks are going to benefit if those trends start to materialize. And what you wind up having is a portfolio that doesn't look like what other folks are doing. So it's really I'm a hockey player by trait. We are trying to go where the puck is going, as Wayne Gretzky says, not where the puck is. So when we think about thematic investing, we want to own the innovation. We want to own the disruptors because those are the companies that are going to dominate the world for the decades to come, kind of like Google and Facebook and Alphabet and Netflix were doing 10 or 15 years ago. So that's how we think about thematic investing at GlobalX. Here we have north of 20 portfolios focused on themes only, ranging from cloud computing to cannabis, to clean tech infrastructure, to robotics and artificial intelligence. And what I'm going to chat a little bit about here is how some of these structural shifts, because of COVID-19, because of the lockdowns, have really started to materialize. And now these are part of our everyday lives. So I'll talk a little bit about a few key themes and how we think about thematic investing. But just to kind of put a little bit of meat on the bone, if you will, I love this slide. These are all of the themes that one could possibly invest in right now, broken into disruptive technology. And we have themes like robotics, fintech, mobility, big data. We've got people-based themes like healthcare. So that could be genomics, it could be biotechnology, it could be longevity. We're living longer. Why is that? Or it could be environmental-based themes like infrastructure and clean energy. So we are doing research on all of these themes to try to understand really where the puck is going and how we as investors can benefit from knowing what the adoption cycle and the adoption curve looks like. And so these are very relatable concepts, and we can see them in our everyday lives really starting to play a pretty big picture in how we operate from day to day. What happened the past couple of months here is, and this is what generally happens with most technological innovation, is technology tends to follow an S-curve of adoption. Now at GlobalX, we want to be early. We want to be in the innovation phase. We are trying to identify companies and sectors as they're starting to grow. Robotics was a much smaller industry 4 years ago than it is today. Just like electric batteries were not really that common 10 years ago, but they are now. What happened because of COVID and the stay at home? We saw that more people were doing new things and adopting these technologies at a faster rate than ever before. So that S-curve of adoption got bigger, more people were using that technology, and those companies made more money as a result. And that's why you saw some phenomenal price returns from companies that do things like e-commerce, mobile payments, online payments, financial transactions. It was a very big shift in what we saw. The biggest example to my family was the silent generation. You know, folks, generally speaking, we're not so adept at ordering things online. If I live here on the west side of LA, if I walked outside right now, there's probably 10 packages on everyone's front door. And I don't think that's a habit or a trend that people are going to wind up giving up on. I think you're going to see that these habits are ingrained in our daily life, and these habits are really here to stay. So COVID-19 really increased the adoption of certain disruptive technologies, and it increased the total addressable market. So that S-curve became a lot steeper. I'll give you a great example of previous technological innovation and how quick that was adopted. But I will highlight, if you look at things like the telephone or the refrigerator or the internet, they're all S-curves. But what we saw at COVID was not too dissimilar from what we saw in World War II and the Great Depression. Certain technologies became adopted at a much quicker rate. Why did the refrigerator become adopted so quick during the Great Depression? Well, that was because people wanted to store their food. It lowered their cost of living, and it was a huge enabler for them to maintain their lifestyle. COVID-19, we're now using e-commerce almost daily, and that is a very, very big theme. We are seeing people look to cannabis as almost like an alcohol staple, which is very interesting. So that's another component that we're seeing. Robotics have been adopted on a massive scale from companies like Amazon and Shopify and all of the firms that are doing this. So COVID-19 has really changed how we operate in our day-to-day life. To put a little context around that, we had nearly 30 big chains go bankrupt last year. We had Neiman Marcus, Brooks Brothers, Lord & Taylor, JCPenney. These big companies that were late to the innovation, they're no longer here, or they're going through a restructuring process. So these trends we believe are here to stay. They've become ingrained. Right now, we're cloud computing. We are doing a Zoom call. We have 50 plus people on this call, probably all over the country, which is fantastic. These are themes that are here to stay. And from an investment standpoint, these are themes we want to own over the coming decades, be it infrastructure, clean technology. So we've moved on from the stay-at-home to the reopening. And this is kind of where we are right now. We're in this phase where safety and flexibility dominates our life. I heard someone earlier was in Florida. I was on the East Coast over the holidays. It's a wildly different place than California, where I am today. But it's safety and flexibility is what our life is characterized as right now. You're seeing a mass exodus from large cities. We have a fully distributed workforce at GlobalX all over the country. We're very well set up for the work from home environment. But we want to get back to the office. I want to have a cup of coffee with Brad. I hope to be able to do it soon. So we're kind of in this reopening phase. So that kind of brings us to, okay, so what's next? What are the themes that are going to benefit? We just had this highly politicized election. We don't need to get into politics, but I think calling it politicized is a fair statement here. And the new administration has outlined some key themes that Brad just mentioned, from infrastructure to clean tech, renewable energy, the legalization of potentially cannabis on a federal and recreational level at a state level. So we'll talk about a couple of these key themes and really where we're coming from here. So which themes stand to benefit from the reopening economy, from robotics to cloud computing to infrastructure? And so it's going to be a very interesting couple of years here. We're very excited as investors at GlobalX. Entrepreneurship and innovation always win. And that's one thing I think we can all find solace in. And so I'm going to first talk about a theme that's near and dear to me, which is clean energy infrastructure and technology. Now, the Biden administration announced just yesterday a $1.9 trillion COVID relief package. As Brad mentioned, there's likely to be a $1,400 check that is going to be going out to those that are in that income bracket. One thing to look out for, next month, they're going to talk a little bit about clean technology, energy, and what the infrastructure bill could look like. As Brad mentioned, these stocks have been hot on fire, and that is ahead of any sort of bill, just because folks know that this is an area that we really do need to be putting dollars towards. So right now it's all preemptive, but I'll start out by defining what we think about clean technology. Then I'll talk about infrastructure, talk about cannabis, and then digital currency, and then lithium and battery technology here. What is clean technology? I love Palm Springs. It's one of my favorite places to go. I'm from Chicago, so when I head up there, that place looks like something I never dreamed of, right? When you drive out and you see all those solar farms and all those wind farms, I get very excited. That is a clear-cut example of one of the largest yieldco properties, or it's basically an on-ground wind farm. That's a big component, is renewable energy. We've got energy efficiency and storage. So you're starting to see all these smart grids pop up in Century City and all these places to charge your car. Very interesting. You have smart grids, which are able to look at what are the traditional patterns of usage in a particular neighborhood, and how can we make sure that we have the power available, but then save it and store it in those fuel cells and in those ion batteries. We have electrified infrastructure. So you're going to have smart and clean buildings. That's been going on for some time. The Biden administration does have some plans outlined for what they want to do there. And then lastly, the last subsegment of clean tech is emission reduction and removal. So you have carbon capture, carbon dioxide removal. You have energy companies that are now spending as much money employing their workforce as they are to actually develop clean energy infrastructure and clean technology. I was actually reading an article just last night about the Permian Basin, and ExxonMobil and a couple of the other big midstream drillers are now using carbon capture on site to basically take out any of the pollution right there on site and put that back into the ground. You're going to continue to see this. So I'll break these things out, but a couple key things that have been outlined. So by 2035, Joe Biden administration they want to decarbonize the energy sector to the best extent that they can. US buildings and the carbon footprint need to be reduced by 50%. So you're seeing a pretty significant push here. Getting a little more specific, last year, this actually was verified yesterday, NASA released that 2020 was the hottest year on record, or the second hottest year on record, tied with 2016. That's within a margin of 0.5 degrees Celsius. But you saw a pretty significant uptick in natural disasters. You've seen a pretty significant uptick in temperatures in general, and infrastructure costs dollars on the back end for all of these challenges. We saw this with the Camp Fire as a utility issue, cost $16.5 billion. Flight delays as an infrastructure component cost the GDP about $28 billion. So there's this growing threat of climate issues and infrastructure issues that we can address. The beauty of the situation is COVID-19 has been a terrible thing, but there's a lot of job creation on the back end of that. So you're seeing temperatures have increased. It does pose an economic risk, but there is also going to be a silver lining here that we can tackle this, and we might be able to solve this before it becomes an even bigger problem. Now, why clean technology? Why is this an interesting investment, and why is this a sector we do believe will grow over time? 75% of warming does come from CO2. We know this, but we think clean technology can turn this around, produce jobs, and ultimately produce investors an opportunity here. So if we look at it, we look at renewable energy, fossil fuels, energy efficiency, electrified infrastructure, carbon capture. The clean tech industry is set on a big run here in the coming decades. It will have its highs and lows this year, just like most investments will. But we do believe that the clean tech energy, just in general, is really going to be here to stay. So I want to just point out one chart here. Substituting fossil fuel with clean alternative energy could reduce emissions by 52%. Right now, we have about 26% of the energy produced today is renewable. And that's a pretty significant growth. But we are very much lagging from where we need to be. The dollars are about to flow here. So it's a very interesting industry that we want to be tracking over time. I'm going to dovetail that into a little bit. I used to drive a lot all the time, and I live near the 10. The amount of potholes that I've hit, I could not count with a calculator. So when we think about clean technology infrastructure, we also think about US infrastructure. And US infrastructure is a theme that needs quite a bit of dollars spending. There's a huge spending gap. I don't know if anyone's ever heard of the American Society of Civil Engineers, but the American Society of Civil Engineers ranks the US infrastructure system a big fat D+. Not the best number. Now, we need dollars to go to surface. We need it to go to utilities like the Camp Fire I mentioned. We need it to go to the airports. We need it to go to railways. There are massive problems with the infrastructure that we have in the United States. And for whatever reason, this has not been an issue that Congress has been able to get behind. To suggest that politics are polarizing would obviously be a very blanket statement today. Let's hope that the parties on the right, the left, and the middle, and the extremes can come together to pass something. We do believe that the infrastructure bill is likely to be the most obvious and hopefully tangible bill that we can possibly get done here. But a couple of interesting stats for you guys. The funding gap for transportation is at $1.1 billion. Utilities, 285. Airports, 42. We have a significant need across the country here to develop and to build and to create jobs. And ultimately, this is a win for everybody. So we have seen these outlines from the administration come out already. The Trump administration had mentioned they were going to do it as well. There was certainly some turmoil in Congress, but now we do believe that there's an opportunity for this to happen. So clean technology, that is one. And then just plain old transportation, mining, construction, trains, and rail. These are industries that have a significant need, and I think we all agree that we would likely benefit from that. Here's an interesting chart. This is the infrastructure spending relative to our GDP growth. For whatever reason, it continues to go down a couple halves of a percent almost every year. A few dollars will really increase our opportunity to not just fight climate change, but to just address daily problems. Now, one thing, Brad, that I think we talked about a bit too is this urbanization or the deurbanization. People are moving. I have the amount of people that I know that are moving to Utah and Wyoming and Idaho to get out of the big cities. They're going to need more broadband connections out there. You're going to need more roads. You're going to need more airports. So it's very interesting. These consumer preferences have changed because of COVID. So it's pretty likely you're going to see these exodus, not from big cities entirely, but people are realizing they can work anywhere. That's going to require infrastructure spending. So it's fairly low-hanging fruit in our opinion. And that's going to be something you're likely to continue to see. Now, we want net zero emissions by 2050. So the infrastructure needs to be put in today to be able to do that and achieve net zero emissions by 2050. And so what are a couple things that you can expect the administration will do? And there's, how is this ultimately going to get built? Well, you can issue executive orders. President-elect Biden has indicated that he will rejoin the Paris Agreement. Dodd-Frank provisions basically will require banks to disclose that if they are working with fossil fuel administration or not. You're going to see across the executive branch, Department of Transportation, the head of the EPA, the chief of staff. You're going to see the Department of Energy. You're going to have new people appointed to focus and tackle on these problems, and you're going to have an infrastructure bill behind it. So it is pretty likely you are going to see a significant spend. I'm a bit of a technology geek. I love this stuff. And I think you're going to see a big component of smart cities now. You're going to see cities that are going to be put together where it's going to be much more efficient for traffic, pollution, environmental tracking. So clean technology, energy infrastructure, these are themes that we do believe are very much here to stay, and a couple of things to really look out for. Now, the next theme, and this can be a little polarizing sometimes, but the next theme that I will talk a little bit about that we do expect, and you kind of, as Brad mentioned, the stock prices are a little high, pun intended, is cannabis. Now, cannabis is interesting. The country right now, 70% of us can access it to some extent in a medical format, around 30 to 35% in a recreational format. Global cannabis sales in 2019 was around 15 billion. In 2020, it's around 20 billion. The annual growth rate there, as you can see, is around 27%. But there are just a number of sort of fast facts on the cannabis industry that I'd like to share while I keep this slide up. But just to slow it down for a moment, there are flowers, there's hemp, there's oils, there's extracts, there's CBD, there's gummies, there's candy bars. I can't even keep track of all of these things that are coming out now. The real incentive here, because of COVID, is what does this do with tax dollars? Yep. States need dollars to go fight this virus, to roll out the vaccine. All of these things cost money. So there, whether you are pro or con on the industry itself, the expectations, we have about $130 billion in tax revenue that can be collected from this. Now, I will give you a couple interesting facts about what happened during the earlier days in the pandemic, but it is somewhat interesting. So Canada has it fully legal. Online cannabis purchases in Ontario went up from 5,000 orders to 9,000 orders in 2 weeks in April. Oregon cannabis sales increased 37% in just March alone. In California, Colorado, and Alaska, recreational sales were up 50% just between March 16th and March 22nd. So people are using this almost like a consumer staple, not unlike alcohol, which went up around 7.8% in the financial crisis in 2008. So people are clearly using this and they're leaning into it. And it's not just flower, but it's a multitude of products, which is very interesting. So from an investor standpoint, whether or not you are a fan of this or you love it or you hate it, the use is on the rise. And you can see that here in terms of the sales revenue. You have billions of dollars that are being generated. And if you look at it state by state, these are the taxation levels. 15% excise tax in California, 15% in Colorado, 7% in Illinois, but 10% on all flower products. These states are charging a lot of money. It's a very profitable industry, and it's in its very, very early innings. Brad, you and I have chatted about this, a lot of conversation around the green rush and what that looks like. And that does, in our opinion, really show that this trend is very much here to stay. You are likely to continue to see investors talk about this. It will have its highs and lows because it's an industry that is really growing at a pretty quick rate. And with that will come some volatility. But just a couple of other, fast facts for everyone. Halfway through 2020, there were 385 new stores. In Colorado, there are 180 stores per 1 million people. Wow. Growing very, very quickly. So it is something to look of that. And if I look 10 years ago, there were no places you could buy cannabis legally. So whether you love the industry or whether you hate the industry, I'm an investor. GlobalX, we're an investor. These companies are making money. And this is a new pharmaceutical industry that's going to generate a ton of tax revenue. What do states need right now because of COVID? They need tax revenue and they need job creation. And we do believe hundreds of thousands of jobs will also come as a result of this. And it's not even federally legal yet, which does create challenges and some volatility. But you're going to continue to see the adult use numbers here tick up and likely move to the right. So it's a very interesting thing from an investor standpoint, regardless of what the opinion might be on the product itself. It is something with the administration who has, preliminarily said that like there is an opportunity here for federally legal cannabis. So just one thing to look out for there. And then to the kind of last couple of points that we were chatting about here. Autonomous vehicles, electric vehicles, cryptocurrencies, and Bitcoin. I'm just going to show you a couple slides. I have been a car guru for a very long time. I have an electric car. Electrification is something near and dear to me because it's very renewable and it's sustainable. But lithium is really very much an interesting investment right now, not just because of Tesla, but I have a smartphone here. This is the new Apple iPhone, and it's about 10 grams of lithium here. I've got a tablet behind this laptop. That's around 25 grams. My laptop itself is around 35. I have a hybrid car, so I can use gas and I can plug it in. That's around 5,000 grams. You have a lithium car, a fully electric car, you've got about 40 to 80,000 grams of lithium. So lithium demand is going up significantly along with electric vehicles. Electric vehicles today make up roughly 3.8% of the driving fleet globally. You have pockets of places like Norway where 52% of the cars are actually now electric. And then you have places like Kansas where middle America, they're not really driving it yet. So I would just say that electric cars are very much here to stay. The cost of an internal combustion engine is nearly at parity with an electric car battery. Not quite, but it's really close. And that's going to come out very quickly here. So you can kind of see the average cost here. It's come down significantly from around $900 to around $130. And the lithium demand is kind of the opposite chart here, where you're going from around 300,000 to around 2.8 million in MT. So it's very interesting as a kind of another theme to really chat about. And then Brad, you mentioned digital currencies and fintech. I'm going to talk about that for just a second, then we can go Q&A. That's more fun anyway. Mobile payments have increased roughly 44% year over year. We are all using Venmo instead of using cash. Generally speaking, if I'm paying the dog walker, I probably just use my phone today. It's a little bit cleaner. It's a little more efficient. You're seeing banks try to get into the financial services industry using technology companies. And then you've got this entire payments ecosystem of digital currencies. What is it? How do you value it? Somewhat of a confusing conversation, but fintech is crowdfunding, blockchain, and alternative currencies. And banks are going digital because it's clean, it's easy, it's actually a little bit safer. Cryptocurrencies are certainly polarizing. As Brad mentioned, it is to some extent a new store of value, or it's a way to hedge your exposure with interest rates. Gold is becoming less of a popular vehicle to do so. So you're going to continue to see the rise of mobile payments, which are going to carry digital currencies. And Brad, to your point, it's very interesting. Square reported that their revenue from Bitcoin reached $875 million last quarter. That would be a 600% year over year increase. So you're going to continue to see large financial institutions leg into things of this nature. So when I put it all together, what did COVID-19 do? What's going to happen moving forward? If we had that crystal ball, I think we would all be wealthier individuals. I'm not sure what that's going to look like. But what we do know is that investment themes are very much here to stay. The structural changes have been accelerated. Clean energy infrastructure, carbon capture, decarbonization. These are all things that hopefully we can get behind, one, to solve the world's problems, and more importantly, to create jobs. From an investor's perspective, we think it's an opportunity from an investor perspective for higher returns. Our world is going to be characterized by flexibility and safety, and our preferences are going to change. Digital currencies are likely to continue to increase. You're going to see the Biden administration probably push for legalization of cannabis, even if they hate it because they want tax dollars. And a lot of these themes are ingrained in our daily lives. This will not be, I have 3 more Zoom calls later today. This will not be the end of Zoom. I will not be going into an office as much as I used to. So we believe these themes are very much here to stay. And I'm excited for some Q&A because these industries can get really granular very quickly. And then I'll show you a couple of pictures from the Consumer Electronics Show just to wrap it up.
Hey, Devin, while you're okay, go ahead.
Oh, I was just saying I'm open for Q&A, Brad, and whatever questions you kind of want to get to here.
Thank you. Actually, can you go back to that last slide, the key takeaways, please?
Absolutely.
Thank you. This is really good because actually we get a lot of questions from clients. And we're going to turn to questions now surrounding, this is all really interesting, but how do I actually benefit from this? How do I take advantage of it personally? And so at Legacy Wealth Partners, actually 3+ years ago, we had this idea that thematic investing was going to become a really relevant thing. And myself and my partner, David Tracy, actually worked on this for a few months and decided to start a strategy that we would manage that we called Thematic Wave. And we've been running this portfolio now really since the latter part of 2018. And so we use some of the products that you guys at GlobalX offers. We also use funds from different sponsors. This is a portfolio that we manage investing in various different ETFs, exchange traded funds, and all of those representing each a different theme. Now, this is an actively managed portfolio. So the weightings that we have in each of these different holdings is going to change over time. We're going to add, delete, adjust up and down these various exposures. But actually, currently, the themes that we all discussed here today are really covered in the portfolio, including things like biotechnology, cancer treatment and immunotherapy, video games and esports betting, cloud computing, cybersecurity, cannabis, Bitcoin is also in the portfolio, robotics and automation. These are all things that we're investing in through our Thematic Wave portfolio. Now, we run a lot of different investment strategies for our clients, covering the gamut from very conservative to more aggressive. This strategy happens to be one of those more growth-oriented or more aggressive strategies that we offer, but we're seeing a lot of success with it. In fact, last year, our return for the year was in excess of 65% in that portfolio. So we're pretty excited about that. We're getting off to a good year, first couple weeks here for the beginning of 2021 as well. And so with that, why don't we open it up and start taking some questions from the group and make this more of a discussion. So if you have a question or comment you'd like to make, please go ahead and hit the participant button on your computer or your screen, select chat, and then we'll go ahead and take your questions. Okay, so I have a question here. Okay, this one is regarding, let's see here. I'm gonna read this one real quick. Venmo recent security alert concerning Venmo and other digital payment processors concerning the use of Plaid. And let's see, I don't know if you can see this, Devin. In reality, consumers are unwilling to give their login credentials. Let's see. Okay. Devin, do you have anything you can comment on related to this question? It's a pretty lengthy question related to the security protection measures of digital payment processing systems and concerns surrounding that.
Yeah, it's a great question. I actually have a friend that works at Plaid in the UK. It's a valid question. It's a problem they're going to have to figure out. But thus far, you have seen some issues with privacy, security, and digitized investment and digitized storage of cash. You've seen a lot less challenges there than you have with banks and actual hard cash and currencies.
Very true.
So it's a completely valid question. None of these companies' stocks have a chance at surviving unless they take security first as a measure. And Venmo, Plaid, Square, PayPal, those companies have all made it their staple to do that. So it's a concern. I have that concern. But at this point in time, I frankly am probably as comfortable with a digital storage bank as I would be with a hard cash application, just because I do think the regulatory scrutiny is going to come behind it. The dollars are going there. It's actually related, Brad, to another theme like cybersecurity. Most of these themes are interrelated to some extent. And I do think that you're going to see hard cash will lose out because it's not as safe, and digital banking is going to be safer moving forward. It's pretty hard to rob a digital bank because they're in the internet. And as long as cybersecurity is taken into consideration, which you're seeing a lot of dollars flood into cybersecurity as well, I'm interested to see what Venmo does. They're going to continue to invest in R&D there. I use Venmo every day, but I'm not concerned about that in the next decade being a big of a problem. But these are early days, these are early themes, and there are challenges. But I would suggest that it's likely as safe, if not safer already, than how we were doing banking 10 or 15 years ago.
Yeah, and I think that's a really good point, Devan, because while we do have these concerns as we're dealing with nascent technologies here, the reality is that there are far greater ways that people's financial accounts can be manipulated under the previous status quo. So as an example, we've had a number of clients tell us over the years that they have become victims of identity theft through, statements being stolen out of their mailboxes or credit cards being taken from them. Or in fact, I was a victim twice from my bank where I had checks that were taken out of a mailbox and washed by the perpetrators and then made payable to other payees. So there's a lot of means of manipulation, but certainly in the digital world, there's going to be a lot of development that provide much better protection as time goes on. The other question that we have here is, what's your impact of the value among these high-flying stocks in these sectors? Is the market subject to a pullback? Where do you see the best value in terms of growth at a reasonable price among these various and compelling long-term themes? And Devan, I'm going to turn this back to you in a second, but what I want to say is that valuations being at extreme levels are a very big concern right now. In fact, the valuation of the S&P 500 is at or near at least an all-time high. The S&P's PE ratio right now is about 23. Now, if you look at it in terms of breaking down the components of the market index, actually the 10 largest stocks in that index have PE ratios closer to about 33. And if you took the market index and took out those top 10 stocks, the remainder has a valuation of about 19. So what we see is that there is a concentration of a smaller number of stocks that are really overvalued. And we are starting to see actually is a rotation away from those to the more value sectors of the market, particularly in things like financials, energy, some of those items that we talked about earlier. But we're also going to see pullbacks from time to time. And historically, the average drawdown intra-year in the stock market, meaning from its peak to its trough before the recovery begins, has been on average about 14% a year. So we expect to see those pullbacks, which actually present opportunities for investors. And one of the things that I think is really critical for every investor to understand is that in investing, there is always uncertainty and always periods of risk. And what I've learned as a professional investor is that it pays to lean into those environments. When other people are fearful, that's the best time to be adding to your portfolio and take advantage of that uncertainty. Because when things are at a price point where everybody's excited that they're making a lot of money and they don't want to miss out, and we're getting calls from clients saying, Brad, I need to have more stock exposure, more, that's when we start to worry that things have gone too far. And it's those periods of periodic uncertainty and volatility that actually present the best opportunities. All right, so Devan, you want to talk about, in terms of the areas that we talked about, I think a lot of people would naturally think that when we're talking about thematic investing and disruptive technology, that we're actually talking about high tech. And that's not necessarily the case. So do you want to address that?
Yeah, Brad, great points there. I agree with everything you just said on the valuation perspective, and you're starting to see this bifurcation between growth and value. And the reality of the situation is, while timing is always the challenge, a lot of these themes, if you try to do it, it's funny. I look at a company like Amazon, and I thought it was too expensive 5 years ago, and here you are hundreds of percents later, and it's still something I wish I had owned more of over the past 5 years. When we look at valuation, which is very important, and certainly things feel like they're very much trending upward right now very quickly, we prefer to look at the sales growth of these companies as opposed to their earnings. A lot of these companies don't want earnings. They're going to take those dollars to go hire more people. Interest rates are effectively zero, so they're going to use that opportunity to double down on R&D and to build more products. And they're using this as a time to really grow and catalyze their business to the next step. So there are certain themes that are quote unquote more expensive than others. Themes that we've chatted about today, US infrastructure has been a dead on the water industry for a decade. It hasn't done anything. It's just started to move. So we actually feel like infrastructure is value at this point, and it's rather cheap. If you look at an industry like robotics, that's not really tech, it's industrial manufacturing. These are big, giant machines, mostly made in Japan, that are then brought here that sit in warehouses and do things all day, 24/7, 365. So there are certain themes that feel very hot, but I would suggest that most of what we talked about today are actually cheap relative to the Facebooks, the Alphabets, and the Amazons. Some stocks are a little hot. You're going to want them to come into parity for sure. But there are actually some relatively inexpensive themes to be had out there. And Brad, the last thing, and you've done so well with your thematic portfolio and what you've done, there are times to buy these themes like infrastructure, clean energy. They have started to benefit already preemptively, but they're multi-decade themes and they're going to take years to play out. So you want to own little slivers of them over time. You're not going to bet the horse on one, but the nice thing about doing it from a professional manager like Brad, and then using managers like ourselves, is we have diversified exposure. So some of those stocks are a little higher valued and a little more richly valued. Other of those stocks are actually pretty cheap. And I would say that the themes that we talked about today, but particularly infrastructure and clean energy, these are really nascent industries. These are second, third inning industries. We would argue they're actually pretty fairly valued. You could argue that cloud computing stocks are a little more richly valued today after a big year. I still think cloud computing is going to be the theme of the decade as people continue to move and continue to work more remote. So I think it's a great question. Valuations are always something I look at, and sometimes they do scare me, but we are staring, hopefully, the vaccine in the arm here. We will hopefully reopen our economy, and I'm bullish on the United States and the world in general. So I do think you kind of have to own these themes for alpha or return opportunity in the coming years. Valuations are a concern, but in the long run, I think these are all going to benefit as we continue to adopt them.
All good points, Devan. Thank you. And there was another question that just came in that I'm going to address, and that was to compare GlobalX versus the Thematic Wave Fund. So let me differentiate that for everybody here participating. So GlobalX is a product manager of primarily ETF funds, all not all focusing around themes, but really specializing in thematic investment products. And whereas Legacy Wealth Partners is a registered investment advisor. We're a financial planning firm. We're a fiduciary to our clients, but the thematic wave portfolio really is a strategy that we manage. It's not a fund. It's a portfolio that we manage that invests in funds. Think of it almost as like similar to a mutual fund, except our investors actually see all the holdings that we own in their portfolio. And they are not, the portfolio is not built exclusively of GlobalX funds. We use products from different sponsors. We're really agnostic as it relates to who we decide to buy products from. And when our clients invest in that portfolio, they're seeing all the various holdings, and also we're adjusting the allocations over time. So like Devan was commenting, he and I were talking just yesterday about one of the funds that they're having a lot of success with right now that's actually investing in infrastructure. And I said, Devan, I get it. My problem right now is I think that actually that segment's run a little bit too far, and that fund is a little bit pricey right now. We're looking at it, but we're going to wait for a pullback. So the way that we look at investing is almost like harvesting crops. We want to plant seeds, meaning buying investments in a portfolio, seeing those crops grow and then harvesting gains. And that means raising cash by selling pieces of the portfolio and rotating that into other opportunities. So actually in our thematic wave portfolio, our cash levels are going to increase or decrease over time based on the environment. We actually got down to a cash level in our portfolio of maybe 3% at the end of the year. And then we raised that to 12% a few weeks ago as we saw several of the different thematic funds that we're investing in getting a little bit too overheated. And so we raise cash waiting for other opportunities to rotate that into when the environment is right. So this is really more of an active managed approach as opposed to investing in individual funds that you might pick to invest in yourself. Also, I want to address another question, and then I'm going to pivot this one back to you, actually, Devan, for your comments. And that is big tech heading towards an AT&T style government breakup? And if so, when? Why don't you go ahead and take that one?
Yeah, that's going to be an interesting topic to watch unfold over the next 2 to 4 years here. So when you think big tech, and this acronym is used a lot, but a lot of people basically refer to it as the FANG. And just for everyone's understanding, the FANG is effectively the big four, and it's Facebook, Amazon, Apple, Netflix, Alphabet. Alphabet is Google, by the way. And then a lot of people will also put Microsoft and they'll call it FANG-M. Now,
or FanMag is another one.
Or FanMag, yeah, that was the other one I was going to say. So that is big tech. Just as a quick caveat, we actually categorically almost own little to no exposure in most of our portfolios because they're not really pure play for the way we invest. We do own some of them in certain portfolios, but that's not our focus here. Now, are they headed for a government style breakup? I don't think so. Are there antitrust issues with Section 230 in free speech? And obviously Trump just got banned from Twitter. Absolutely. How aggressively is the Biden administration going to go after big tech is to be seen. I think Amazon is one I'm really interested to see what they do. They have Amazon Web Services, or you hear it on the news called AWS. That is their cloud computing business. Amazon, as I use it, is a package provider when I need to order a water bottle or something to that effect. They don't make most of their money doing that. They make more of their money on the web hosting. And the web hosting is what everyone's really concerned about. Facebook is not a web host. Facebook is a social media platform that derives the majority of their revenue from advertisers spending dollars on their platform. So they are very different. I do think you're going to see antitrust, and I think it is more likely to hit Amazon. And it's going to be potentially hitting Facebook and Twitter, but that's going to require Section 230 to be looked at. And so that's something I would say watch out for this year. And then Google. Again, that's the same company as Alphabet, by the way. When you search something on Google, if you start to, we run a robotics ETF, and if you see it, our ETF will start to show up. Google will emphasize certain things depending on the country that you are searching from, the zip code that you are in. If I Google the same thing as you in a different part of the world, we might see different results. That is something that I do find concerning because they are discerning content based on who might be looking to obtain that content and why. How far the government can go in breaking that up, I'm not sure yet because these are still free speech entities. So I cannot say with certainty that there's going to be a divestiture, but I do think you're going to see a lot more congressional hearings with Jack Dorsey and his big old beard. I do think you're going to see Mark Zuckerberg continue to get his face to the fire, and I think it's necessary. Competition is good. Competition levels the playing field, and big tech is debatably too powerful. It's interesting because big tech were these cowboy pioneers of these new industries, Silicon Valley entrepreneurs, anti-corporate America. 10 years later now, they're the big tech cannons. I think there's going to be challenges. I think there will be some antitrust. If it's successful in Congress, I don't know because the lobbying power of these companies is high. In my opinion, it's too high, but I can't say that they're going to be successful in breaking up big tech yet. But I do look out for the Section 230 for free speech. Watch that in the coming years. Definitely watch out for Google and their ad search and how competitive that is, particularly because small businesses could use more attention there. I don't know if Congress has the firepower to get it through yet, but I would say I'm watching it. We are watching it from an investor perspective. That's why we like to buy emerging companies. We prefer that to buying Google and Facebook, in our opinion. So I would just say it's a great question. I'd say it's going to be an interesting couple of years, and there's likely to be some changes, but I can't say with certainty when or how that will look.
Yeah, those are all really good points, Devin. Thank you for that. And what I wanted to add is that there was another question related to that I'm going to address. I'm going to paraphrase it here. Recently, there's been increase in anti-competitive, anti-free speech and censorship activities of some of the major big tech companies, the ones we were just talking about: Amazon, Apple, Google, Twitter, Facebook. And so the question I got is Legacy Wealth Partners taking the position to divest from such companies in the future? To answer that question, I would say no. The reason is, as a very simple example, you could not invest in the S&P 500 today as an index fund, as an example, one of the largest holdings that is in our portfolios and in many investors' portfolios, and not have exposure to those companies. But we do have concerns about that, and that relates to the ability of governments to implement measures to limit the control of these companies. It is something that we are concerned about. I don't know, I'm sure a lot of you saw the documentary called The Social Dilemma, which basically was really about the power of these social media companies to form public thought and policy and actually influence what we believe is fact, whether it is fact or not. So it's something we are concerned about. And we definitely champion those companies that go against the status quo. It's kind of funny because, as Devin said, a few years ago, it wasn't that long ago that we thought of these companies as the challengers to the status quo, and now they are the establishment. So those emerging companies that are coming up with alternative means of communication that are challenging the status quo leadership, definitely we welcome that, and we want to participate in the growth of those companies as well. Another question I want to address relates to cryptocurrency, and this was it's a bit more of a complex question, but it was addressing the opportunities for trading cryptocurrency and the growth of that. And one of the things I think is important to understand is that today the options for people to invest in and hold and trade cryptocurrencies, it's really still in I'll call it the frontier days of investing. There's not a lot of products out there. There's not many options available. It's a very inefficient market as far as the ability for people to buy and hold or sell these products. And there's a lot of growth to be done. A lot of development is going to be taking place over the next few years, where it's going to become more and more institutionalized. And there's going to be a lot of options available for people to own and hold and also trade these products as time goes on. But we're still at just the very, very beginning. All right, let's see what are the questions we have. I'm running through them. All right, if we have any other questions that we haven't addressed yet, please go ahead and just post the question in the chat, or feel free to raise your hand, and I'll be happy to address those questions in the next couple minutes, and then we're just going to wind it up here and wrap up for today. Do we have any final questions or comments?
And one thing, just for a point of clarification, Brad, that you made, so the great thing about working with you, and Brad's totally right. I mean, we happen to have a number of strategies that are doing very well, but some are up here, some are in the middle, some are down here. When I work with advisors and investment managers like Brad, they're able to understand when to put cash to work and when to raise cash and when to take advantage of these themes. And, Brad and I worked quite a bit together in the first and second quarter of last year, and he nailed a lot of these trades back in April. So, these themes have their time in the sun. We would argue that they're all great evergreen themes in the coming decades. But when you work with a professional investment manager, our job is to find these companies and understand how to create investment strategies around them. And then Brad, as a professional manager, can take advantage of them at certain times. And he's done a great job of that. So, these themes, have their highs and their lows, and working with someone like Brad really does help mitigate some of the risk around it, because you do want to own them. I would argue you have to own these themes in the coming decades if you want that kind of outperformance. But I would say it's very, very helpful to have a fiduciary like Brad to watch these themes, because they do have their highs and they do have their lows, and there's times to go in and there's times to come out. So that's sort of the difference. We are the manager, and we do all of the research on these strategies, and then Brad makes those decisions. And from my experience in the past couple of years, he's done pretty well with his calls there. And that's kind of how the capacity that we get to work together there. But it's a lot of fun to talk about these themes. And Brad, if there aren't any more questions, I can happy to show a couple of pictures of CES real quick, because that's a big thing.
A few more questions that just came in. So I'm going to go ahead and field these and we'll maybe wrap it up in the next 5 minutes. But thank you for your comments there. And yes, as fiduciaries to our clients, our job really is to manage risk, as I would say. It's not to avoid it. And that's another important distinction, because the way that we look at it is that we don't progress in terms of creating and building wealth or generating income for our clients if we avoid taking risks. But at the same time, we want to make sure that we do it responsibly, that we tell our clients when it's time to lean in and be more growth oriented, or when it's time or appropriate for them to be more conservative. And that really is determined on an individual case by case basis. And as Devan pointed out, what we saw last year was an environment where the world just essentially froze and shut down, and people became very fearful. And then as early as April, we said, you know what, it's time to lean in, because the recovery is inevitable. And you may remember, those of you that are clients of ours, I did that series, the 5-part series on the roadmap to recovery and the bear market survival guide. And we walked you through the steps that we felt were important to take, and we definitely took advantage of it. We've got a last few questions here that I'm going to address. And the first one is, are there health stocks in the thematic wave portfolio? Yes, as I mentioned, we're investing in an ETF that is related to biotech, and another one that's related to cancer treatment and immunotherapy. And Devan, there's a question here for you that I want to give to you to answer, and that is, what GlobalX funds are focused on lithium mining and processing? I know you have a specific fund for that, right?
We do have a specific fund. I can't talk too detailed on that, but we do run a portfolio. It's called LIT, and it's lithium and battery technology. And we are focused. Lithium is an interesting industry. It's to some extent a commodity. Lithium is extracted from the ground. Lithium takes 5 to 7 years to brine. The majority of lithium comes from South America, notably Chile, starting to come more from China. As they're putting a lot of money towards that. So lithium is this sort of wild west industry that is now booming because of the demand for electric vehicles. So what you find is that the lithium grade quality for a phone is much different than what I need to put in my car. And that is a very interesting thing. So we do run a fund called Lithium and Battery Technology, and we invest in the full lithium cycle, from mining and refining all the way through battery production. So we own material companies, we own industrial companies, we own battery manufacturers. It's a very interesting industry. And Brad, it's actually our oldest thematic ETF. We launched it way back in 2010. It was the first one we launched. And it's had its ups and downs for different reasons, but we do believe with the electric vehicle push, that has arrived. Lithium is here to stay, and that is what is going to be in our cars for a long time. So I love talking about the industry because it's interesting to me. But yes, check out Lithium and Battery Technology if that's of interest. Talk to Brad, and he can kind of give you the rundown there. But we have a lot of research on our website too, as well, and there's some good resources there.
Devan, actually, I'm glad that you mentioned the availability of information through your website. There were a number of people that actually requested to get copies of the slides on the disruptive themes in general. So we're going to go ahead and actually send that out to all the participants, so everybody has that information available to review at your leisure. And with that, I want to go ahead and thank you, Devan, for joining me today. This has been great. I've really enjoyed it. I want to thank all of you for joining us as well and participating. This has really been fantastic. Thank you again. I want to wish you all a very happy, healthy, and successful new year. And if you have any individual questions or items that you'd like to address with us, please feel free to reach out to me. You can email me at blevin, that's BLEVIN, at legacywp.com. Or you can call us at 818-995-7733, and we'll be happy to chat. All right, thanks. Take care and be well.